It's a pleasure. So yeah, as I was just discussing with Narivia, this is an ongoing project. It's an ongoing work that I'm doing together with Chris Axelson from the Treasury and Dina Pomerans here at the University of Zurich. And this is a preliminary version of the paper. So yeah, I apologize for that, for not being able to show the final results. And obviously looking forward to your comments and questions after the presentation. So what we try to do in this paper is to assess the pension-related expenditures in South Africa. Just let me give you a quick background of why we are looking at this topic. So as you all know, population is aging at an accelerated growth rate worldwide. That has been the case in many advanced economies, but recently in many developing or emerging countries, that also has been an issue that is widening. This has a lot of consequences, social, economic, such as, for instance, increase of age dependency ratios, which is crucial for the sustainability of pension systems worldwide. So there's evidence in East Asia and Pacific of very fast aging of societies, but also in South Africa, although it's not one of the main issues in the country, it has been accelerating in recent time. So that has, as I said before, several implications, and one of the main issues is the impact on pension systems and the sustainability of pension systems worldwide. So as a result, governments have been trying to kind of push the burden of providing retirement income out from the public sector in order to shift the burden into the private sector. How are they trying to do this? By boosting private saving for pensions. For instance, switching to pay-as-you-go, from pay-as-you-go system to funded systems. That's something that we have observed in many countries over the last decades. There are specific and more general measures, including broad reforms. But one key policy instrument to change behavior of savers, also in the context of pension savings, regards taxation, and particularly what we call in this paper pension-related expenditures, which are tax incentives to boost the savings that people, active workers, are putting into the retirement funds. So just to give you a more formal definition of what we understand in this paper as pension-related expenditures, this is the preferential tax treatment of retirement savings, and as defined by the OECD, this is the amount that an individual saves in taxes paid by contributing to a private pension plan over her lifetime cycle, instead of putting the same amount into an alternative benchmark saving vehicle. So this tax advantage can be as high as 37% in Australia, 46% in Hungary, and in Mexico for some pension plans for public servants, 281%. So this can be really significant. So the problem with these pension-related expenditures is that, as many other tax expenditures, these are costly. So the revenue forgone of these provisions is very considerable. And even more striking, they are often ineffective in reaching the goal, which is boosting pension savings, and also can trigger negative externalities or undesired effects, such as the regressive distributive impact. So let me touch on these three factors: the cost, the ineffectiveness, and inefficiency that they trigger. So when it comes to the fiscal cost of the revenue forgone of these provisions, just to give you a few examples, in the US, this can be around 13% of total tax expenditures, 190 billion only for some of the benefits provided through the tax system to boost pensions. The same in Australia, this can be as large as 9% of total tax revenue, so this is huge. In Australia, these provisions are called superannuation, and there's also a big debate around these tax expenditures there. So as I said, it's not just about the cost, it's about whether policymakers are reaching the objective for which these provisions have been in place. And what the literature finds is that very often these tax benefits are redundant. So a very small fraction of funds or savings can be considered new saving. There's a lot of reshuffling. So moving from a saving vehicle to this pension savings just to maximize or minimize your tax liability, maximize your tax benefit. There's a bit of substitution effect that is found out there in the literature as well. So there's a similar paper by Chetty and co-authors in 2014 where they use, as very often, Danish data, and they are able to disentangle the effect of active and what they call active and passive retirement saving policies, and they obviously find that the elasticity of total savings to passive to pension tax expenditures is low, but as expected, the passive policies, so the ones that do not require an action of the individual to be claimed, is higher. So, and on top of the lack of effectiveness in boosting pension savings, there's an additional issue, which is the distributive impact. Here we come a bit more to the design, how these benefits are implemented or designed. The reality is that very often these are granted as deductions from taxable income, which, that it's kind of a mechanical impact because this is the benefit that you get out of it because of being a deduction is negligible for individuals with low income and hence facing low marginal income tax rates, and the opposite for rich individuals. So the more you earn, the larger is the benefit you take out of the provision or the scheme, and that's why, in general, what we find or is finding in the literature is that the net impact in the distribution of income is regressive. So again, here a few examples: 70% of the tax benefits for employment-based retirement savings in the US are captured by the top 20% of filers. Similar pattern in Australia, where most of the benefits are captured by the very rich. So where there are empirical studies assessing how the distributive impact of these provisions, in general, what is found is that indeed these provisions are regressive. So what about South Africa? Well, again, as I mentioned before, it's not urgent and in many other countries, but population is indeed aging in South Africa as well. So it's expected to double the share of people over 60 by 2045, sorry. So as in other countries, the government has been trying to take action and boost private savings, also through the implementation of pension-related expenditures. So in South Africa, we have a tax-deductible fund contributions, also a tax deferral and growth in the fund, and a preferential tax treatment when the money that we put into the fund is exiting the fund for retirement. So the three stages obviously play a role, but in this paper, what we are focusing on is on the first stage of the upfront tax deductions that we get in order to put money to contribute to retirement funds. So in a nutshell, the pension tax expenditures, pension-related expenditures in South Africa allow both employers to deduct a certain share of contributions to their employees' fund as a business expense, and employees to deduct a certain share of their own contributions to reduce their own tax liability through personal income taxes. Again, in South Africa, pension-related expenditures are very costly. Indeed, these are the largest tax expenditures in the country, amounting to more than 72 million in 2016, the latest year for which there is data. This is roughly 35% of total tax expenditures and 68% of total tax expenditures granted through personal income taxes. But more importantly, the overall tax expenditure system accounts for 5% of GDP. So this is a lot of money that the government is foregoing or not collecting in tax revenue, and pension-related expenditures is the largest item in there. So also, as it's the case in other countries, there's an issue on how effective and regressive these provisions are. So this is a quotation from a discussion paper from the Treasury 2012, where already there was a debate about these provisions. You can see here that they flag both that they are not effective and then they are not fair or regressive. So the barriers to a more effective tax incentive regime are the complexity of the current regime, where there were 3 different tax funds with tax dispensations applying to each of those, as well as the fact that the regime is open to abuse through excessive contributions by employers and high income earning individuals. The tax exemption has no nominal monetary cap by that time. In the case of higher income employees, allowing them to make tax exempt contributions way in excess of the amount required to maintain a reasonable standard of living in retirement. So here we clearly see that at that time already there was discussion about how effective and regressive these provisions are or were. So what happened is that in March 2016, a comprehensive reform to the retirement system was implemented with mainly 2 goals. One was the simplification of the tax system, and the other one was to increase the fairness or reduce the regressive impact of the whole scheme. So among other modifications that, for instance, included changes regarding whether funds must be taken as a lump sum or as amortization, the reform significantly had an impact on pension-related expenditures, mainly through 2 channels. One was a harmonization of the limits, and when I refer to limits, I mean the definition of the income base and the thresholds for tax deductible of contributions to each of the 3 different funds. And when it comes to fairness, there was a specific provision introduced, which is the 350K cap to the overall to the 3 funds tax deductible of employees' contributions. So these 2 measures are the ones that we are trying to assess in this paper. And the research questions and main findings are these ones. So what we try to do in a nutshell is to find out whether pension-related expenditures have a positive impact in contributions. So are they effective at boosting pension savings? And also, besides this potential impact on the level of contributions, who is really capturing the benefits of the pension-related expenditures? So is this disproportionately captured by the very rich, as we have seen in other countries, or is not the case? And again, this is a very relevant topic or question in a country like South Africa, where it's where high inequality is already a core topic, or it's one of the more unequal countries in the world. Just to give you a bit of a background compared to other countries. So South Africa, here you see the Gini is one of the highest in the world, but it's not only that the picture today or in 2014 here, what is striking in South Africa is that the trend has not, we don't observe that the situation is improving, like in Brazil here, where inequality has been reducing in the last 10 to 20 years. In South Africa, it has increased or at least remained stable for the last year. So this is a long-standing issue. So what we find in the paper is that the reform did have a large effect in increasing contributions to retirement funds, mainly to retirement annuity funds and provident funds, not much, as I will show, to pension funds. These seems to be to a large explained by the extensive margin. I will tell you more how we define the extensive margin, but in any case, as an introduction, so contributions can increase either because the number of individuals putting money into their retirement funds increase, that's what we call the extensive margin, or because filers are increasing the amount that they contribute to pension funds. So that's what we call the intensive margin. So what we find here is that it seems that indeed there was a bit of an effect in boosting the number of new savers into retirement funds. So when it comes to the cap for the tax deductible, overall tax deductible after the reform, what we observe is that it did have a significant effect in reducing the number of people contributing above that cap, but only in the year right after the reform. What we observe is that there's a jump back to the pre-reform level or trend as for T+2, that's 2018, so 2 years after the reform. When it comes to the distributive impact, we observe is that, as expected, the reform increasing the benefits, the pension rate tax expenditures, actually worsened the distributional impact of the whole scheme. So let me tell you a bit about the data, and then I will dig deeper into our results. So the data we are using in this paper is the individual panel that was created by Chris Axelson, one of the co-authors of this paper, and Amina Ibrahim, in the context of the new wider project. So I give you a bit of information here, but it's I can recommend that you take a look at this paper, 2018 paper, where they very in detail describe how that was built up, and it's I can say a very useful set of information, impressive effort that the Treasury in partnership with the Uniwider have been doing to give access to data for research purposes. This is not the case very often in many countries. So in a nutshell, what we get access through this is tax return data of all taxpayers in East Africa. So it's composed of 4 different panels. But at the end of the day, what we get for this paper is the final income position of the individuals in South Africa by year, and after including all kinds of information regarding tax benefits. So that's, I would recommend that for more details you take it at the working paper. And then what is clear is that this data, although it's very detailed and vast, has certainly limitations. One, which is not negligible, comes from the fact that we are using tax return data, and hence by construction we are missing all people that are just outside the tax system, so informal workers or informal employees, which in South Africa are estimated to be around 20% of total employees. So all these guys are clearly outside our paper. We can capture the impact that any reform or tax benefit has on them. The same for very low earning wages, so people not filing because they are below the tax threshold. It also means those individuals. And obviously this is not negligible, because in the discussion of inequality, these informal sectors and low wage earners are obviously a group we would like to take a look at, right? But we cannot do better than that. On the other side of the income distribution, there might be issues of tax evasion, tax avoidance. There is some literature there showing how tax evasion avoidance can be misreported or underreported through tax return data. Again, using mainly data, we cannot capture that. It's what it is. And one crucial thing for our paper is that before the reform, there was no information on employers' contributions to pension funds and provident funds, because just simply that was deemed a fringe benefit and hence was not part of individuals' tax calculations and tax filings. So we just miss that part of the story, the employer contributions before the reform to these two retirement funds, pension funds, and provident funds. We do have data for retirement annuity funds. So that hints clearly the comparability between the pre or before and after reform periods. We try to deal with this issue as much as possible throughout the paper, clearly. So let me jump to our preliminary results. So when it comes to the effectiveness and the simplification of the tax system, what we observe is that overall the reform did 3 behavioral response. So here, what you see on the left panel is the number of individuals contributing to each fund. So here, what you see, it's clearly there's a big jump when it comes to retirement annuity funds, the number of individuals contributing to retirement annuity funds and provident funds. We do not see much effect, actually observe a slight decrease when it comes to pension funds contributors, individuals contributing on these funds. And the explanation is clearly to the measures that were implemented. So provident funds and retirement annuity funds were the funds where the benefit was increased the most, right? So pension funds before the reform already, contributions to pension funds were already able to deduct up to 27.5%, which is the new threshold after the reform. So there was not much of a benefit for those guys. And this decrease, our intuition that a bit of softening of people moving from pension fund to one of the two funds, right? It's kind of switching for tax reasons. This jump back we observe here for annuity funds is likely to be explained by timing and data. So timing of filing, simply the retirement annuity contributions come through the ITR 12 forms, and these were not taken into account when the data was imputed at the time. We hope and we assume that with the new wave of data of 2019, this jump back will not be there anymore, or at least considerably reduced. So we expect to find a similar effect to the one from the provident funds here. So we observe a similar effect on what we call the intensive margin here. Although I have to be honest, this is a very preliminary result, because what we observe here is the total jump in the amount contributed by individuals, but we are not yet, and we plan to do so, disentangling the increase in the amount of new contributions from increasing the amount of previous people that were contributing to pension funds. So in order to be sure that we are talking about an intensive margin of investment decisions, we need to be sure that this is due to new contributions, not only to the total increase in contributions. So the results on the right panel are to be taken cautiously. We need to work a bit more on those. In any case, what we observe here is that the jump on the extensive margin is very considerable. So there are around more new 700,000 people contributing to provident funds, and around 800,000 new people contributing to retirement annuity funds. So that's something that one of the goals of the reform was to boost pension savings, and this should indicate that there was a bit of an effect on that note. So as I said before, we're currently working to better disentangle the effect of the additionality. So clearly disentangle how much of on intensive margin side is due to new contributions. But that's work in progress. So when it comes to the cap, the 350K cap that was introduced to the overall tax deductible, what we see here is that the year right after the reform, there was a significant reduction on the number of people contributing off the threshold. So as you observe, this number was reduced considerably with implementation of the reform. What is a bit surprising for us is that in what we call T+2, so 2 years after the reform, that number seems to have come back to the pre-reform trend, right? And again, here we are starting to see where we can come up with some explanation based on data. So far, we have is more an intuition of what this could be. The explanation is that people might have realized that after all, contributing above the tax benefit threshold is still a good deal for the very rich, because they still get kind of a tax benefit at the end of the day, in the sense that well, you know, contributions above the threshold are taxable now, but tax-free in retirement. And yeah, even if they will pay some tax on the investment return, this is deferred. So, you know, for people that are trying to decide how to deal with their retirement, this can still be a good deal after all. So if that's the case, though, what this chart would be suggesting is that the effectiveness of pension-related expenditures is very low, right? Because actually the very rich are even contributing when they don't get tax benefits of it. So I will come back to that point later. So in terms of the number of individuals contributing in relation to the applicable limits, so this is how it has changed with the reform. So the three blue panels that you observe here are the contributions by retirement fund before the reform. So for, let me check the panel A, this is for pension funds. The threshold was 7.5% of retirement funding before. And before the reform, we did observe a lot of bunching here, right, as expected. So most of the contributions were done until the threshold, as expected. The same for the retirement annuity fund, where the threshold was 15%. So again, here, there are a lot of contributions below the threshold, but we do see a big bunching at the threshold at 15% of non-retirement funding income. For provident funds, there was no threshold, no limit before the reform. So that was, you know, the distribution seems more like a normal distribution, although we do some bunching at 7.5% here. Again, cannot, you know, we cannot explain why some data. It might be just mimicking what the pension funds threshold was, but this is just an assumption. The orange panel here at the bottom right of the chart is the new situation after the reform. So where all these three, the limits up to the three were harmonized, unified, and the new threshold was 27.5 of gross remuneration. Here, we do see a bit of bunching, but as you observe, the bulk, the majority of contributions are actually being done way below the threshold. So if anything, this chart suggests that before the reform, people seem to adjust their saving behavior more based on the tax or on the tax benefit than after the reform. So let me just quickly show you. So this is exactly the same panel that I show you here in panel D after the reform, but splitting by different types of contributions. So there are people that only contribute to retirement annuity funds, the ones in blue here. Same for provident only. So that's the bulk of the contributions for low and medium income earners. For pension funds only, you see that increases a bit with income, although it decreases at the very top of the income distribution. But there are people that contribute to 2 or even 3 pension funds. Okay. So what about the distributional effect of pension related expenditures? Where this is the distribution of how, you know, how the tax benefits granted through these provisions are captured by income decile. So one first thing that this picture shows us is that the first 4, even 5 deciles of the distribution do not get any benefit out of contributing to the pension system. So these guys are really not getting anything, not targeted by those provisions. So those provisions, if anything, have an impact on the behavior of people in the 6th, 7th, 8th, 9th, and 10th deciles of the income distribution. And obviously, the benefits captured by individuals increases significantly with income. As you can see, the largest part of the benefits are being captured by the top 10 deciles. This is a clear indication of how regressive the scheme is. So here in blue, you see the situation before the reform. In orange, you see the situation after the reform. So you see that, if anything, in terms of the distributional impact, the reform seems to have had worsened the situation in terms of who is benefiting of these pension-related expenditures. So the thing is that for the 4 bottom deciles, even 5, because as I showed here, the fifth decile is very small. There's no benefit at all of contributing, but still there are 1.2 million individuals that contribute to retirement funds, even when they don't get any benefit through the tax system. What is striking is that the top 20% of income earners, that is people with taxable income above 300,022 rands, capture more than 80% of the benefits, more than 80% of the total benefits. And if you compare that to the examples that I gave before based on US and Australia, then the distributional impact is even worse than in those countries. So when we take a look at what is happening across funds, we observe that indeed this is replicated across funds. So the regressive pattern of pension-related expenditures is present across all the 3 funds. Again, we can only compare the pre or the before and after reform period for RIs, for retirement funds, because of the lack of data for the other funds before the reform. But even there, we see that the impact has been to increase the regressiveness of the provisions. So in terms of conclusions and policy implications, or wrapping up, yeah, we can say that pension-related expenditures are the largest tax expenditure in South Africa. They account for 6.4 percentage points of GDP. So this is huge. It's a lot of money being, channeled through these tax benefits. So the big question is whether these are effective at boosting pension savings. There's a bit of data issues, but we are able to show that the reform seem to have had an impact in changing behavior and in boosting pension savings, so in increasing the number of new contributors to the pension system. So that is one of the goals of the reform. Then this follow-up question is, at what cost, right? What is the cost of increasing this pension savings? And when I mean the cost, is not the fiscal cost, it's the cost in terms of increasing inequality. Well, again, we show that the reform seems to have worsened an already very strict situation in terms of inequality. And we came up with some very rough estimates. Again, we are still working to dig deeper into this assessment. But if you take a look at the Gini index country, we see that the reform actually increased the concentration of income in South Africa. So here, the chart to be looking at is the second one, because if you take taxable income or deduction that people the tax income is reduced, and that has mechanical impact on the Gini. So we take here is disposable income, and we take disposable income, we actually capture the impact on inequality of that reform. So that's just a very rough confirmation on the regressive impact of the reform. When it comes to the impact of the cap, we only see a temporary, very short-term effect, but that vanishes right at the year after in 2018. So in terms of policy implications, one message or takeaway of this would be that one of the reasons explaining the regressive impact of these provisions is that they are granted as deductions, right? And deductions increase the benefit you get reductions is with your tax liability, which is a function of your marginal tax rate, which is a function of income, right? So one main message could be to move from deductions to tax credits, as it was the case in South Africa years ago in the system. There was a reform that moved from deductions to tax credits that could make the trick, or that could mitigate the impact. But if we really wanted to get, and that knows the paper Senia and Dimo that's been done in the same project, SA TED. So I recommend you to take a look at that paper if you're interested in that topic. But in any case, what could really improve the distributional impact of these provisions is to actually not only switch to tax credits, but to switch to fully refundable tax credits. Because as we observed before, we are missing low-income earners, and those guys not be taking any benefit even if a tax credit was implemented. In order to reach poor households, we need to think of other instruments like refundability or co-contributions or another policy instruments. Just to give you a quick example on how generous the scheme is in South Africa regarding the very rich. So in South Africa, the cap that was introduced with the reform is more or less 4 times the median yearly taxable income. Okay, the median yearly taxable income in South Africa is around 88,000 rands. That's more or less 4 times the cap. The cap is more or less 4 times that median income. In Switzerland, we have a similar scheme where we can contribute to our pension funds and get a tax benefit out of it. But that tax benefit is capped at 6,000, bit more, almost 7,000 francs a year, which represents the median monthly wage. So the cap represents 8.6% of the yearly gross remuneration. Okay, so whereas in Switzerland we are able to get a benefit up to almost 9% of our yearly remuneration. In South Africa, the very rich are able to benefit more than to 100%. It's a big difference. I think it's one of the reasons why the system is as aggressive as it is. So yeah, I will stop here. I would like to have a more complete version soon. So yeah, looking forward to your questions or comments. Thank you.